Lam Research Corp, ticker symbol LRCX. We are looking at a closing price of $160.52 per share. That is a sharp, jagged decline of $8.19, representing a 4.85% drop for the session. The market is currently closed, so this figure represents the final sentiment from Friday's closing bell. And if you are holding this stock or watching from the sidelines, that red number probably feels heavier than it looks. It wasn't just a slide, it was a stumble. Now, here's what you are likely hearing from the headlines and the buy the dip crowd on your Robinhood app. The expectation right now is that this is simply a healthy correction in a massive semiconductor supercycle. The narrative is that Nvidia stock and the AI data center buildout are rising tides that will lift all boats, and Lam Research, being a critical tool maker, is just taking a breather after hitting near record highs earlier this week. It feels safe to assume this is just profit-taking, right? That is the expectation, a pause before the next leg up. But here's the reality, and it is significantly more uncomfortable. This drop isn't just about traders cashing out, it's about a crack in the moat. The catalyst that many retail investors missed while checking their SoFi Invest dashboards is a report that surfaced regarding Intel testing chip-making tools from a competitor, ACM Research. For decades, Lam Research has been the undisputed king of etching, the process of carving microscopic canyons into silicon. The reality forcing this price down is the fear of vendor diversification. Big chip makers are tired of being beholden to a single supplier, and if Intel is flirting with other vendors, that safe monopolistic premium baked into Lam's stock price begins to evaporate. The market isn't selling because of today, it's selling because it's worried about 2026 market share. Let's pull this apart piece by piece, because if you're managing your own capital through an individual brokerage or using Schwab Intelligent Portfolios, you need to understand the mechanics of this move, not just the percentage. First, look at the volume. We saw over 11.4 million shares trade hands on Friday. The average volume is closer to 9.3 million. When volume spikes on a down day, that is not retail traders on Robinhood stock trading panicking over a lunch break. That is institutional conviction. That is funds and asset managers, the kind operating through Fidelity Wealth Management or managing massive Fidelity ETFs, trimming their exposure. They are rotating risk. When the smart money sees a headline about a major client like Intel testing alternative wet etch tools, they don't wait for the press release confirming a contract loss, they sell the rumor. We have to contextualize this against the broader sector. We often compare the volatility here to Tesla stock or even Apple stock, but the semiconductor equipment space is a different beast. It's cyclicality on steroids. Tesla stock moves on consumer sentiment and delivery numbers. Lam Research moves on capital expenditure budgets of 3 or 4 massive companies, Samsung, TSMC, and Intel. If one of them sneezes, Lam catches a cold. And Friday looked like the start of a flu. Let's talk about the specific pressure point that is creating this tension, the China export controls. You cannot discuss Lam Research without addressing the elephant in the room. This company historically derived a massive chunk, sometimes up to 30 or 40% of its revenue from China. We saw fresh updates on export regulations recently, and while the company stated the impact is consistent with expectations, the market hates a ceiling. Every time the U.S. government tightens the screws on what tools can be shipped to Chinese foundries, Lam's total addressable market shrinks. The expectation was that AI demand in the West would offset the loss in the East. The reality is that the loss in the East is immediate and structural, while the AI gains are lumpy and competitive. So what exactly does Lam Research do? If you are new to online investing or just looking for investment help, let's break the business model down without the engineering degree. Imagine building a skyscraper, but the skyscraper is the size of a fingernail and it has 100 floors. You need to lay down concrete, that's deposition, and you need to carve out windows and elevator shafts, that's etch. Lam Research is the company that sells the jackhammers and the cement mixers. They don't own the building, they sell the tools to build it. Specifically, they are masters of etch. They use plasma, superheated ionized gas, to selectively remove material from a wafer to create the transistor structures. For the last few years, as chips moved to 3D structures, like 3D NAND for memory, Lam was the only game in town that could dig those deep vertical holes with precision. That dominance is what drove the stock price from the pre-split equivalent of the 80s to where we are now. But the news about ACM research suggests that the etch monopoly might be softening. If competitors can do the job cheaper or good enough, margins get squeezed. Now, I want to pause here and ask you a question about your own portfolio strategy. Comment below how many shares of Lam Research you currently hold, or if you are waiting for a lower entry price. Are you buying this dip, or do you think the geopolitical risks are too high? Let's look at the technicals on the chart, because this is where self-investing gets tricky. The stock had just hit a 52-week high of nearly $170 before this reversal. That 170 level is now a concrete resistance ceiling. When a stock fails to break out and immediately reverses on high volume, it creates a bull trap. Investors who bought the breakout at $168 are now underwater and will likely look to sell at break-even if the price bounces back, creating more selling pressure on the way up. If you are using SoFi trading platform or Interactive Brokers trading setup, you might be looking at the moving averages. We are testing short-term support here. If 160 breaks decisively next week, the next major floor is down in the 150 range. That's where the value buyers might step in, the folks who aren't chasing momentum but are looking at the price-to-earnings ratio and saying, hey, this is still a profitable cash machine. And it is a cash machine. We cannot ignore the fundamentals. Lam Research has incredibly high margins because once they sell a machine, they sell the service and spare parts to keep it running. It's the classic razor and blade model. The installed base of machines is huge, and those machines need constant maintenance. This provides a recurring revenue stream that cushions the blow when new machine sales slow down. This is why many Fidelity mutual funds keep holding it despite the volatility. The cash flow is undeniable. However, the AI narrative has warped expectations. Investors hear AI and think infinite growth, but AI chips, specifically the HBM that NVIDIA stock needs, require very specific tools. Lam is well positioned there, but the memory market, NAND and DRAM, is notoriously boom and bust. We are coming out of a bust, which is bullish, but the recovery is slower than the market wanted. The expectation was a V-shaped recovery in memory spending. The reality is a U-shaped drag extended by consumer weakness in smartphones and PCs. Let's shift to the macroeconomic view. Interest rates are sitting at levels where capital is not free anymore. For a company like Intel or TSMC to buy a $100 million tool from Lam Research, they need to be sure they can get a return on that investment. High rates dampen CapEx. If you are using SoFi Active Investing or Robinhood Cash Management to park your cash, you know that 4 to 5% yields are attractive. For a risky semiconductor stock to be worth it, it needs to offer significantly more upside than a risk-free treasury bill. At a PE ratio that has expanded significantly this year, Lam Research has to prove it can grow earnings, not just ride the multiple expansion. There is also the Silicon Forest expansion to consider. Lam recently opened a massive new facility in Oregon. This is a double-edged sword. On one hand, it shows confidence and aligns with the U.S. CHIPS Act, bringing supply chains home. On the other hand, running factories in the U.S. is more expensive than in Asia. This could weigh on gross margins in the short term, a nuance that automated SoFi robo-advisor algorithms might miss, but human analysts are watching closely. If you are looking at investing sites or reading interactive brokers' stock trading forums, you will see a lot of chatter about the splits. The 10-for-1 split in October 2024 made the stock more accessible to retail traders using Robinhood fractional shares. But splits don't change the fundamental value of the company. A slice of pizza is the same size whether you cut the pie into 4 or 8 pieces. The psychological boost of the split has faded, and now we are left with the cold, hard math of earnings per share. What should you be watching for in the coming weeks? The critical catalyst will be the upcoming earnings call from Intel or other major customers. If they confirm a shift in CapEx strategy or mention supply chain diversification in their etching tools, LRCX could see further downside. Conversely, if Lam announces a breakthrough in cryogenic etching, a next-gen technology essential for the super tall 3D NAND stacks of the future, that could reignite the bullish narrative instantly. We also need to talk about the competitive landscape in China itself. Domestic Chinese toolmakers are not just sitting idle, they are innovating out of necessity. Every month that Lam is barred from selling a high-end tool to China is a month that a domestic Chinese competitor gets to practice and improve their own version. The moat is being filled in by geopolitics. So